The U.S. now has more reported cases than any other country in the world. Nearly 45,000 of those cases are in New York State.
And so it continues. How much worse will it get before it gets better? And how can you continue to protect yourself while trying to keep your money safe in this new corona economy? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services and also the brand ambassador for the Retirement Income Store. If the numbers are accurate, and of course that is an if, the U.S. now leads the world in reported coronavirus cases. In a way, though, that's really not surprising. Think about it. As a society, we value our independence. After all, we are the land of the free, and we are the home of the brave. That's why the social distancing measures meant to slow the spread of the virus have been really difficult to enforce. Fortunately, that's changing, especially now that the White House has announced a 30-day extension of its coronavirus guidelines. People are now encouraged to avoid crowds and stay at home as much as possible through April 30th. And who knows how much longer after that. Naturally, that means the U.S. economy, or at least most of it, will continue to remain on hold for that much longer. And that goes for much of the global economy also. The Federal Reserve and lawmakers have already taken major steps to deal with the mounting economic toll, and more actions are likely to follow. We'll talk more about that today and about how this new corona economy is triggering changes that are likely to remain permanent even after the crisis ends. We'll share valuable tips and insights on what you can do to prepare for these changes while also trying to protect your money right now. Of course, Jeff Small will be joining me again this week for the discussion as my co-host, who is also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up, the founder of Arbor Financial Services, a retirement income store located right in Melbourne, Florida. We're also going to be speaking with businessman and economist Mohamed El-Erian, the chief economic advisor at Allianz. We'll also hear from author, advisor, and CEO of McLean Advisory Group, Scott McLean, whose new book, Three Blind Mice, How Today's Financial Planning Process Leads Your Money to a Mousetrap, and how that book's coming out about a week and a half from now. But for right now, let's quickly recap some of the major developments in this coronavirus crisis. As we had mentioned before, federal social distancing guidelines have been extended through the end of April as confirmed cases of coronavirus continue to rise right here in the U.S. In addition, on March 27th, President Trump signed into law the sweeping $2 trillion coronavirus relief package approved by Congress. It's called the CARES Act and represents the largest emergency aid package in U.S. history. It passed shortly after jobless claims hit a historic high of over 3 million in the final week of March, and then surged to more than 6 million just this past week, according to the Labor Department. Meanwhile, Goldman Sachs forecast that second quarter GDP growth could come in at a minus 24%. Which would also be completely unprecedented. The bottom line is that we're in uncharted waters in many ways with this pandemic. We've never had to deal with anything quite like it before, either from a social, a medical, or an economic standpoint. That's largely why stock market volatility has hit historic levels since all this started. Remember, the stock market's driven by emotion and is largely forward-looking. Looking ahead in this situation, investors have been bouncing back and forth between extreme fear and occasionally cautious optimism. They just really don't know what to expect because no one really does. That's why the government's relief plan is so expansive and why the emergency measures recently taken by the Federal Reserve are also largely unique. They've slashed their benchmark interest rate to zero and launched a no-ceiling quantitative easing, along with other measures meant to artificially stimulate spending and borrowing. The hope is that all of these moves by the government will help businesses and households not only weather the economic shutdown, but also get back on track as quickly as possible when the crisis is over. But how realistic are these goals? Let's ask my co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Also, Amazon best-selling author. Jeff, glad to have you here today, man.
Hey, Dave, it's great to be here. And I know the last couple of shows we've been talking about the effect of the coronavirus on the economy. And I'll tell you, the numbers are getting to be pretty epic right now. Have you seen the numbers lately?
I have seen the numbers, and as I put out a video to my clients 3 weeks ago, I said, I think just the way exponential math works, this is going to be a lot worse than most people think. I wouldn't be surprised if we have 1 million people affected in the country by the end of April, just the way it's growing.
Yeah, I would agree with that. I think, but globally, we're over 1.5 million now, and we're 205 countries, and I think the global implications are going to be very bad for many countries. But if there's a light at the end of this corona tunnel, I really think if you look at South Korea and Hong Kong, they've been able to mitigate it, and people are getting back to normal there. And so if we can just get to the apex of this virus, we might be able to get through it in the next 2 months to 90 days.
I think it's a little optimistic. I hope you're right, for sure. Especially now that we've launched, supposedly, if you could believe the numbers coming out of the Chinese government, supposedly we've launched into the #1 spot worldwide for the most cases. What do you think of that?
Well, I don't think we'll ever get the true numbers from China, but I do know that our experts here in our country are worried about the resurgence of the virus in China, and as of Wednesday night, they closed down a city of 600,000 in one of the Hubei provinces there, and they've got them on full lockdown because they're afraid the virus is going to reignite. And that's one of the reasons why we haven't taken such draconian measures here as of yet.
Yeah. So let's talk about the economy for a minute then, if we must, right? Because that's what we do. So, Goldman Sachs came out and said we can see about a 24% GDP shrinkage in the second quarter. That's pretty radical. What do you think about that?
Well, I'm not surprised because we took an economy that was running at 100 miles an hour and we've slowed it down to about 10 miles an hour. And you just can't do that. You lose too much inertia. It's not possible to recover quickly in that kind of environment. And we've lost, over 10 million jobs so far as the 2 unemployment reports that have come out since Corona, Dave. I mean, it does not look good.
Yeah, we had 3 million week before last. We had 6+ million this past week. This week coming up, who knows? Your guess, my guess. I think the numbers might increase for a couple more weeks before they kind of level off and come down. But the problem with unemployment is it's not about that week's numbers. It's really about cumulative numbers. So even when the numbers peak in terms of new weekly claims and start coming down again, the cumulative number will still be going up radically, right?
Well, they really will. And for people that are laid off, what chances of getting a job do they have? Because we went from an economy that was continually hiring for years, for over 11 straight years, and unemployment was at its lowest, to now an economy that's firing everybody and not hiring. So if you've got a job, you're very fortunate today.
Let me ask you personally, we're both business owners. From your business, have you looked into any of the loan passages in this act passed by Congress, the things that are possibly forgiven down the road if you keep all your employees? Have you looked into any of that stuff?
I have, Dave, and for a business owner that has less than 500 employees, part of that stimulus plan, which really wasn't a stimulus plan that Congress passed for $2 trillion, it was really a relief plan. It wasn't stimulus because it's not going to stimulate the economy, long story short, but it's like applying for a small business loan. You got to do an SBA. And when you do an SBA, you're working with your bank. And you know what kind of hoops you got to jump through, Dave? You've been through those hoops, right? You know what that's like.
Yeah. Not to mention the fact that who the heck knows if they can even logistically handle the volume that's coming in. How are they going to administer this thing? That's what gets me concerned. I'm interested to ask Mohamed El-Erian in just a couple minutes about that when he comes on, what he thinks about what Congress passed and which components he thinks are good and which components he thinks are not so good. It'd be interesting to get his point. How about what's going on with the Fed right now? Where do you think they're headed? Because we're going to be talking to Mohamed about that too, but I want to get your feedback first And I want to see how close what you have to say is to what Mohamed has to say later on in our show.
Well, Mohamed is one of my favorite national guests. He's on the networks regularly, and he calls it like he sees it. He's honest, and he gives you his best perspective. And I would suggest that investors heed his words and listen to what he has to say because he tells the truth. The Fed is doing what the Fed does, Dave. They're trying to stay out in front of this, create stimulus, keep the rate curve inverted, provide liquidity where liquidity is needed. But as we discussed in last week's show, they're out there buying corporate bonds and bond-based ETFs and municipal bonds, and they're providing liquidity to the credit markets right now and keeping the repo market flush with liquidity. So they've got to march to that tune until we see the final economic results of what's going to happen with this new corona economy that we're in.
Now, of course, for our viewers, as I said to you last week, because of all this working remotely, we actually have to record this a couple days before Sunday morning. You're seeing it on Sunday morning, so we're not even exactly sure at this time how the markets are going to close on Friday. So Jeff, let's talk about this. So far this week, we've had a mix, right? Past week, we had Monday strong in the markets. Then we had a downturn. We had a little uptick again. Don't know how it's going to close on Friday. What do you see happening for the week coming up in the stock market? What's your best crystal ball? And I know you don't have a clock in front of you. We got 45 minutes to commercial break. 45 seconds.
Well, we had a 10% increase from the bottom, and that was mostly due to pension funds rebalancing and mutual funds rebalancing, and that ended on Tuesday. And now we're expecting volatility the markets to become more headline driven, and volatility will kick back into play. And basically, we're looking for the markets to keep trending to the negative at this point and give back some of their 10% gain recently, Dave.
Yeah, you're right. The professionals got involved. They found an opportunity. They started to buy. But now emotions take over again. And I think you're right. We could be looking at another down leg coming up this week. So let's take a commercial break. We come back. We're going to ask Mohamed El-Erian what he has to think about all these issues right here on the Income Generation coming up in a moment. Stay with us. We'll be right back. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan. As you know, the coronavirus stimulus package includes one-time checks for millions of workers below a certain income level. Most adults will get $1,200, while those with children will receive another $500. For workers who have already lost their jobs because the pandemic's hit to the economy, that money will probably be used to pay essential bills. However, even for those fortunate enough to still be working, the question becomes, how likely are they to put that money towards something that helps offset the impact of the economic shutdown? Well, personally, I don't believe that's very likely at all. Much like the Federal Reserve's efforts with quantitative easing all these years, I believe Congress's plan has a fatal flaw. Yes, all the textbooks say that if you flood the market with cheap money, it'll stimulate the economy by giving people more money to spend. But those textbooks don't address one essential question. What happens if nobody spends that money out of fear? Or what if they use it to pay down debt? Or if they simply save it again because they're worried things might get worse before they get better, which is very understandable at a time like this. We saw this play out in the painfully slow recovery from the Great Recession. While all the Fed's artificial stimulus did create an asset recovery, it didn't really create a strong economic recovery at all because most people were afraid to spend and borrow again after the financial crisis. So again, we had an asset recovery, but not so much an economic recovery. And I think that same issue is going to severely limit the government's ability to manage the economic toll this crisis takes in the weeks and months ahead. Now, this isn't to say they shouldn't be taking action. I applaud their efforts overall and believe certain parts of the stimulus package will help and are also quite necessary. For example, allocating billions of dollars to help the struggling airlines. That's a great thing. The airlines have been one of the hardest hit industries in this crisis and are a vital part of our functioning economy. As for other measures, though, including one aimed at helping businesses get low interest loans, I believe they're well intended, but might be just a bit impractical. Like the checks to individuals, I believe their impact might be limited and that the financial markets might just quickly figure that out. That's where we want to bring in Mohamed El-Erian, Chief Economic Advisor at Allianz and also a New York Times best-selling author. Mohamed, thanks so much for being back with us here on The Income Generation once again.
Thank you, David. It's a huge honor.
So first, I want to ask you about the stock market. I'm concerned that when people start to realize that this different way of living, if you will, way of conducting business is going to last a lot longer than they're currently thinking, that there's likely to be a couple more significant down legs on the stock market. Your thoughts about the market in general with what we're seeing?
So I share your concerns, David. I think we have to be cautious here. We have to assume that this is a big shock, and it is. And there are certain things we simply don't know. First, we don't know how long this shock is going to be and how severe. That's a medical call, not a market call. Secondly, we don't know how quickly the money approved by Congress and the White House will get to businesses. Will it get there before they go bankrupt or after? There's a huge difference for markets on that. And finally, the restart is tricky. You don't simply flick the switch. You have a very tricky restart process that's going to lead to a different landscape. So like you, I urge caution. If you're going to make a mistake right now, and the probability of making a mistake is high because this is such an uncertain environment, it's better to make a mistake of being too late in increasing risk exposure than too early.
Sure. I want to ask you about the Federal Reserve, because when you were with us in the middle of 2018, you said you were a little concerned that the Federal Reserve has limited tools in its toolbox, that without support from Congress with issues such as deregulation, all the Federal Reserve can do is basically create asset bubbles as it had been doing for the last several years. So with this last move by the Federal Reserve and quantitative easing and so on, which components of that do you think are going to be useful versus which components do you think perhaps may not be useful in helping the economy in this particular situation?
So the component that was useful and I would say critical was countering what we are starting to see in the marketplace, which was failures, dislocations, discontinuity. Because had that continued, financial dislocations would have reverse contaminate the economy. And had that happened, we would have had not just a Great Depression like the 30s, but also on top of that, a global financial crisis.
When you say financial dislocations, you're talking about keeping the plumbing going, moving in the financial markets, correct?
Correct. It's when the pipes get clogged and you simply can't get anything done. And that is the role that the Federal Reserve can perform really well. What it cannot do, David, is it cannot generate genuine long-term economic growth. It doesn't have the tools for that. So when we emerge from this, we've got to emerge to a more comprehensive policy response that focuses on inclusive growth.
You know, it's interesting. You're right. You could flood the markets with cheap money, but if people are simply afraid to spend, I mean, if they're hoarding cash or selling every investment class around the board to come up with cash, then the reality of it is it's not going to stimulate the economy. So I agree 100%. How about what Congress did just a week ago in passing that $2 trillion package? Do you think that's going to, what components of that do you think are helpful versus which perhaps are less helpful?
I think that both Congress and the White House should be commended for moving so quickly on something that was unthinkable. I mean, 2 trillion was unthinkable, but it shows you that this is a generation-defining moment, and leaders have to step up to the plate on that. It's important to know, again, what it can do or cannot do. Let's not call it a stimulus package. It is not a stimulus package. This is a relief package. This is helping people through a very tough journey. But like you said, no matter how much money I put in your pocket, you're not going to go out and spend it. So we're not going to stimulate the economy. We're just going to minimize the damage so that when we come out of this, we haven't sacrificed jobs, businesses, productivity, and a lot more.
Think about it. Even if somebody is making less than $75,000 a year, just because they get a check for $1,200, once again, doesn't mean they're going to go out and just spend it in any way that's not significant. I mean, yes, they might go and buy more food or things like that if they've lost their job, but I don't see what it's going to do to stimulate the economy. So I agree with you there. So now, you may not know this, but you have been, especially in my early years as a bond guy, you have essentially been my role model, okay? So whenever I get the chance to pick your brains for free when it comes to the bond industry, I love to do that. And since I have a captive audience right now, allow me to do that for a moment. We've gone through, and the biggest thing that we've done is looked at liquidity ratios, because at a time like this, I think corporate liquidity ratios are much more important than coverage ratios. So if you were to calculate a burn rate in terms of how long that liquidity could last with corporations, I know it's different across industries, but as a general rule, how long of a burn rate would you want to see in a bond issue to feel comfortable that this company is going to be able to weather the storm?
So first and foremost, I think it's critical for people to listen to what you just said. This is the most important thing to look at when you're deciding whether to invest or whether to get out of a company, even at lower prices. Does the company have liquidity resilience? Can it keep the lights on? And that question, unfortunately, David, is not being asked enough. And the reality is there are certain companies that have up to 3 months of that. Most companies have up to 6 or 9 months of that, and only a few have beyond that. My view for my own investments, David, has been to go way up in quality, go up the ones that have the longest runway, because I don't know how long this is going to last. I do know that if it gets addressed quickly and we're back to normal, whatever that looks like, I will make some money on the ones that I've invested in, not as much as I would have made had I taken the risky bet. But if it turns out that it lasts 9 to 12 months, I won't lose all my money. For the risk, we have 20 seconds left before we have to take a commercial break. So with the risk of putting words into your mouth, you'd want to see about 12 months of liquidity then, it sounds like. Is that about right? Correct. And access to markets. That's the 2 things I would like to see.
I love it. I love it. As usual, I really appreciate your words of wisdom, Mohamed, and I appreciate you being a friend of the income generation. Thanks so much for being here with us today.
It's an honor, David. Thank you.
So as we all adjust to the social impact that the coronavirus has caused, many of us are probably thinking on some level that we just can't wait to get back to normal. Yet many agree this event has already triggered some changes that are likely to be permanent, which is always true with a large-scale crisis of any type. It was true after the Great Depression, World War II, 9/11, the financial crisis, and will be true this time as well. We will get back to normal eventually, but it will be a new normal, I'm sure, in many ways. For example, some of the industries that are being hit hardest by the shutdown may take years to recover, and some may never fully recover. I already mentioned the airlines, for example. A recent Harris poll indicates that many Americans may not be willing to get in an airplane and fly for months, maybe years after the federal coronavirus precautions have been lifted. In other words, the psychological recovery period is going to continue hitting many industries, and some may not survive it. Restaurants, theaters, concert venues, for example. Some people are seriously questioning whether going out to the movies will become a thing of the past, particularly with so many new films already streamed directly into your house. Which brings us to the flip side of all this change. While some industries and businesses may disappear as a result of crisis, others are likely to become more prominent in our lives. Many businesses have been booming because they fit the new normal that is emerging in the corona economy. Netflix and other streaming services are an obvious example. Another one for business meetings, for example, is Zoom, along with Skype and other teleconferencing type apps that have already proven necessary to businesses large and small. Analysts estimate that profits are likely to be at least double for 11 of the Standard & Poor's 500 companies whose products or services have increased in demand due to the pandemic, even as corporate growth overall is predicted to be down around 6% or so in the first quarter of the year. Here's the bottom line. Every situation that creates challenges also invariably creates opportunities. Good financial planning is all about anticipating change and recognizing potential opportunities and then taking action. On that note, let's bring back in our co-host, Jeff Small, who touched on this very point last week as it relates to corporate bonds. So, Jeff, before we get to the corporate bond issue that Mohamed El-Erian had talked about, he resonates with us, as you heard, on the stock market, that there's probably another leg down coming up pretty soon. So we're on the same page there. What are your thoughts about what he had to say about, first of all, the Federal Reserve, what the Federal Reserve had done?
Well, I think he was very complimentary of the Federal Reserve, and I agree with what he's doing and what the Federal Reserve is doing at this time. But, it goes back to the original point, Dave. The stimulus can do all kinds of stuff. The Federal Reserve can do all kinds of financial engineering. But if we don't fix the public health, we cannot fix the public wealth. And until we get a hold of the health issues, I'm afraid that the futile efforts of the fiscal stimulus or the relief package by Congress and the Trump administration and any stimulus that the Fed is doing is going to have a very limited range of effects economically. And so the Fed right now is just really trying to do damage control and lift up asset prices. I mean, that's really their job. I mean, wouldn't you agree, Dave?
Yeah, they don't say their job is to lift up asset prices, but yeah, they're trying to do that. Shh, don't ask, don't tell, right? They're trying to stimulate, but you're right, as Mohamed and I had said in the interview, that he probably, people just aren't going to go out and spend. And it's not just physical health, but it's also mental health. I'm starting to hear stories now about people borderline having a breakdown because they've been sitting at home for 2 weeks. They're social people. They can't be social with their loved ones. So it's more than just physical health. It's mental health too in many ways, is it not?
It really is. And, for all the boaters in Florida, the marinas are closed. So I know there's a severe case of boat withdrawal in Florida because people can't use their boats, Dave. I mean, and I shouldn't make a joke about it because I know this is a very serious situation. My sister's a physician and she told me how many people passed away from the virus yesterday. She was very upset nationally that, this is unnecessary, that this should have happened. And so it's impacting everybody's life.
Yeah, I mean, I'll even think of things, a problem that you don't have to think about, Jeff. But, being on television and everything, I'm looking now and I'm saying, I usually get a haircut about every 4 weeks. I'm about due. I'm starting to feel a little thick, a little shaggy, right back here. And I'm thinking, oh my goodness, I can't go get a haircut right now because it's a non-essential thing. And even if he were working, I wouldn't want somebody 6 inches away from me breathing on me. So those types of things are things too that are affecting people. And of course, Teresa offered me to give me a haircut at home, and I'm afraid that's going to start with putting a bowl over my head and cutting around it. So that's already starting to affect me emotionally, just thinking about not being able to get a haircut. So I think our viewers have to think about lots of those combinations and permutations of personal things down the road they take for granted. And that's why I say they've got to get emotionally strong as well as physically strong before they're willing to spend again, before they're confident, right?
Well, the good news is we're going to get through this, and people are going to have to make sacrifices. You and I wanted to be in studio together today, but we chose not to because it's the wrong thing to do. And so everybody else has to mitigate as much as possible so we can get to this crucial peak of this virus, and we can then start to ascend or descend and get rid of this thing.
You were talking to me off the air about the real estate market in New York and some other areas, and why don't you tell our viewers a little bit about what's happening right now in real estate and what you see there?
Well, there's a big vacuum of demand. A lot of properties have been pulled off the market because there's nobody that wants to see them, and there's no buyers. And so what happens in that kind of environment, the projections in some of the major metropolitan areas are real estate's going to drop 25, 30% in market value from present values. And that's going to be a systematic event. It always starts on the top end market and then trickles through the rest of the actual market. So whenever you have any kind of demand destruction for tangible or intangible goods and services, products, whatever, real estate, what ends up happening is prices drop naturally. And so that's just the law of economics. And so that will happen throughout the economy. And that's part of what's happening to the markets as well. When there's no buyers, the markets drop and there's more sellers. So it's the same thing. But we've seen that across the board. And so, we've got this huge bailout talk that we've been talking about, Dave, and you, Mohamed, discussed it quite extensively and all the stimulus, but you can't bail out real estate, can you? Can you bail out real estate? Is that possible? I mean, we're going to bail out cruise ships, airlines, essential industries are going to be bailed out. I don't know if cruise ships should be bailed out, but what do you think?
Well, it's interesting because, we tried to bail out real estate essentially in 2008, and we really couldn't do it as a country. And the problem with real estate is it lags. The real estate, because it's an illiquid asset, it always takes longer. And you're right, some people right now don't want to show their house because they don't want strangers running around who could be coughing or sneezing on things. So they're taking real estate off the market. And people are less willing to put the down payment if their stocks are worth 30% less than they were a month ago. Heck, they may not want to come up with the down payment. They may not be able to get financing from banks, or they may not just even feel comfortable signing on the dotted line for a mortgage. And these things take longer, though. Why? Because the perception of what the house is worth in residential terms from the buyer and the seller always lags. The buyer always thinks the house is worth, X amount of money, and the seller always thinks it's worth X plus something. And by the time the seller finally comes down and says, well, it's probably really worth only X, the buyer now thinks it's worth less than X. So it keeps tracking all the way down, which is why there's always a lag effect with real estate prices. And it could take us, even longer for real estate to recover price-wise than the stock market, frankly.
And that's true. That's been the nature of the history of that asset as we go through the ebbs and flows of deflationary prices and asset prices and back up the inflationary scale like we have. And we've had a really good run, and I don't think we really realize how good that run has been. You never know what you have until it's gone, right?
That's right. The real estate run has been great. The stock market run has been more than great, overdone. And right after the commercial break, Jeff, I want to ask you a little bit about some of your insight as to where you think investors who are more opportunistic right now might want to look for those opportunities. So stay with us. We'll be back here in a moment, coming up with more from Jeff Small and David Scranton right here on the Income Generation. We'll be right back.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementincomeStore.com.
If you're already investing for income instead of growth, odds are that your portfolio has seen less negative impact so far than if you were still invested primarily in common stocks or common stock mutual funds. I've explained why on previous shows, but let me stress the main points again. First, understand that any insured item in your portfolio, such as a CD or a government bond or an annuity, has not been affected adversely by the volatility. Next, any non-insured items, such as corporate bonds or bond-like instruments, might be down in value on your statement, but the dollar amount of your income hasn't changed. Additionally, any loss in value is really only a paper loss. Why? Because these instruments have a par value that guarantees that your investment will be paid back down the road by the issuer, by the borrower in full whenever the bond gets called or paid off. And that's provided, of course, that there's no default. Now, as I also discussed recently, while the current economic crisis may increase the risk of default for some bond issuers, I don't see it as an overall significant risk compared to the risks of owning stocks right now. What's more, actively managed income strategies make it possible for account managers to continually minimize that risk, while also taking advantage of any potential new opportunities that might emerge. As we just discussed, such opportunities are emerging and will continue to emerge in the new corona economy, even in the midst of all the challenges. Now let's welcome back co-host Jeff Small. Jeff, I know you and I share our beliefs in investing for income instead of growth. So talk to me about what else you think our viewers should know this weekend.
Well, you know, Dave, the perspective that our viewers have now is completely different on their money. They're more focused on their health than they are their wealth. And so I think they're gonna be okay, but they have to get back to focusing on their wealth at some point. And they're almost, it's like as a paralytic with what's going on with the pandemic and everything else. So what our viewers have to do today is they have to modernize their money to reflect what's going to happen in the new corona economy. Our dynamic is getting ready to change, and specific sectors will do very, very well. But the greater market is not going to be able to survive doing well, and some companies aren't going to make it through this 2-year transition as we unwind through this. So Dave, I have lots of good ideas on how we modernize through income and how we can modernize through equities. But tell me what you think your ideas are for modernization. How do we prepare for the new corona economy today? What is your perspective?
Well, great question. First of all, going from the G to the I, as we talked about, is just really always the right answer when you have a questionable circumstance going on right now, and as a black swan event, this is certainly questionable. As Mohamed had said also, he agreed that having a 9 to 12 month burn rate, if you will, if you're in fixed income, should be enough to get through the crisis. So that's always one solution, the one that you and I focus on all the time in talking with people. But also, cash is king. You know, if your stocks now are down 20, 25, maybe even 30%, we really think we'll be down 50% at the end of the day. It's not too late to get some money out of the market. People say, advisors will say, well, you can't sell now, you lock in your losses. Well, you only lock in your losses if there's a law that says you can't buy those stocks back. Remember, you can always sell now and buy in at a lower value. So raising some cash to be opportunistic, to be capitalistic, I think is a good thing. Cash is king. If you want to be capitalistic right now in the stock market, I think, you're not looking at the airlines or things like that. I think, you're looking at things that are industries that people are going to need. So, the Netflix, of course, like we mentioned, things that are computer storage, computer, data.
The clouds, the clouds are great. Even Microsoft.
Clouds. That's right. Anything like that, that's going to help people work from home. And that's why all the GoToMeetings, the Zooms and all that have done well. Netflix, people watching movies from home versus the theater. Those industries that people are spending more money in. So I think if our viewers just follow their own dollar right now and where they're spending money, and they look and say, okay, am I just unusual, or are there more people doing this? I think it becomes a common sense function as to where there could be some good opportunities in the market.
Dave, that was very Buffett-like when you said follow your own dollar. I really like that philosophy. Now I'm going to start following my own dollars and see where they go, even though I've got nowhere to spend right now. So other than food and necessities and things for my office, to my staff to work from home. So those are all good points. You forgot about Domino's Pizza. Domino's is structured to do very well too, because digitally, they have the best digital ordering system out there in the marketplace. But I think, a lot of investors have said to me recently, should we buy cruise ships? By the cruise ship stocks. And I don't think cruise ships are an essential industry. I don't see them getting bailed out. And I think as long as there's going to be the potential for a coronavirus in the mix for the next couple of years, we're not going to see that industry recover. So I'd focus on industries that are essential, just like you said. We
need to leave it there. Thanks so much, Jeff, for being back with us. I really, really appreciate it. And like I said, Mohamed is one of my role models. And Warren Buffett's the other, and my good buddy Jeff Small is the other one of my role models. So you stay with us. We have more coming up here in just a moment, right here on The Income Generation. I'll be right back. Welcome back to The Income Generation. Right now, I'd like to welcome income specialist Scott McLean, author of the newly released book, Three Blind Mice, How Today's Financial Planning Process Leads Your Money to a Mousetrap. Scott is also the CEO of McLean Advisory Group in Waretown, New Jersey. Scotty, my friend, thanks so much for being back on the air with us today.
Hey, buddy, thanks for letting me join you. Thank you.
Of course. You know, I really wanted you on the show because we're talking so much today about the markets, the turmoil, the coronavirus, and the things that people are imminently afraid of. But I don't want them to lose sight of the things that they should be focusing on in their financial plan in the big picture, not just in bad times, but also in good times. And after all, isn't that why you wrote the book, Three Blind Mice?
Absolutely, Dave. That's so important. People are forgetting the small details, which could end up to be large problems.
So who are the three mice that you speak of in the book?
Well, they're people we all know. They're our wonderful advisors. They're your CPA or your tax preparer. They're your financial advisor and your lawyer. Very important people that come in your life, and you could be doing things totally correctly for each individual important consultant, but the problem is the trap has just been set.
So why do you call them the three blind mice?
Dave, it's simple. It's funny that I noticed so many times that the advisor or the tax professional, CPA, or the lawyer, they never speak to each other. They speak about their special tools and their techniques, but they don't talk together like a wonderful surgeon would. Holistically, they forget it. They do it simplistically, just their craft. Thus, the client is set up for failure.
I know most financial advisors don't do this. You do. You coordinate with the CPAs and the lawyers. In fact, I know you even have people in-house. But let's say for our viewer who may have a separate investment advisor, a separate CPA, a separate attorney, but maybe the client himself, the viewer himself, actually wants to be the quarterback of his money. How would you suggest that he make sure that these three people talk to each other and are coordinating their efforts?
Well, not to push the book, but I can tell you that if they read the book, they would understand clearly the questions they should ask. On top of that, they need to understand how they work together and then make them talk to each other. Get them on the phone, do a three-way phone call. In these times, it's very important that each person knows exactly what to do to establish this tremendous game plan called the estate.
And right now, it's everyone's doing Skype, everyone's doing Zoom, everyone's working from home. So it's become a lot easier for people who think, gosh, I can't get all these three people in one building at the same time. Right. You don't have to. So as we wrap up, just 20 seconds, tell our viewers where they can find your book. I think it's coming out on April 15th. Where can they find it?
It is, Dave. It's coming out. It's called threeblindmicebook.com. Threeblindmicebook.com. Tremendous read. It's fun. It's exciting, but it's packed with goodies.
Scotty, thanks so much. As a friend of the Income Generation, thanks so much for being back on the show. And I suggest you go out and get a copy of the book, Three Blind Mice, as soon as you can. I'm David Scranton. You're watching the Income Generation. We'll be right back in a moment. Coming right up. I'd like to thank all of our guests for joining us today for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. You don't need me to tell you that these are challenging times. In addition to all the fear and worry, we miss our old routines. We miss spending time with our friends. We miss going out to dinner, going to movies, ball games, visiting our children, grandchildren. So many aspects of our lives have been affected. In the meantime, doctors, nurses, and those in the front lines are stressed to the limit, while many business owners are wondering if they'll ever be able to recover. Some may not. Even whole industries might be permanently changed, along with the way we do business and how we live our lives. We're facing a new normal at the end of all this, and a lot of uncertainty in the meantime. But remember, in the midst of all these challenges, there are also opportunities. Good financial planning is all about anticipating change, recognizing opportunities, and taking action. If you haven't yet taken action to lower your risk and seize new opportunities by shifting your strategic focus from growth to income, I believe that there's still time to do so. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's essential you stay informed and up to date. And right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.